There are thousands and thousands of indicators to analyze the health of the economy and the stock market. There are some which are more telling than others. Some give us a fundamental picture, while others give us micro data. It depends on what we need to know. But when we piece them all together, we start to paint a very clear picture of what the future has in store. You came here for the truth. Today, we are going to look at the most expensive market ever. And we are using the S&P 500 median price to revenue. What they are suggesting is that this is a world of pure imagination. And I do agree with that. This has exceeded the housing bubble. It has exceeded the dot-com bubble. And everything before it, going back to at least 1986. I have shown you many indicators which exceed that which we saw during the financial crisis. It is much worse than the financial crisis, as it is today, in various indicators, not just 1 or 2 or 5 or 10. We're talking about many indicators. Some people will overlook that. Some people will decide not to pay attention to it, but we have to face reality. Because ultimately, people get in over their heads. They get in way too deep. And then they realize it after it's too late. And they've lost a lot of money. And they don't want to sell what they've bought into because they've lost too much as it is. So they keep it in and it continues to drop. And they keep it in and it continues to drop. Because the euphoria takes hold and they simply can't let go. Alarm bells are ringing. That's according to the Sotheby's indicator. Now what we can see here is that we've exceeded that which we saw in the past. Here we are today, looking back throughout the financial crisis, looking to the, to even 2007, if you want to point it out right there, which was really the beginning, although technically the low in the stock market was March 2009. We saw all the cracks definitely appearing in 2007. By then it was very apparent. And right back here throughout the tech crisis, these are always leading indicators. So we see that prior to the crashes, and you will notice here that we are facing the music, essentially. Let's move on. Sell the S&P. The stars have aligned. The S&P 500 index recent upside, according to the DeMark, sequential upside red 13 exhaustion. So it's all very technical. Let's not get into it too much. But essentially what they've said is that the S&P 500 has a 5 to 10% downside potential based on this indicator. Okay, not much, but that is a correction, saying that it's based on this indicator, also based on seasonal readjustment of what we will generally notice throughout the months coming into September, October. Now, this here would not be a surprise to me whatsoever. 10%, that it should come down. In fact, if you believe in the market, if you want it to be healthy, you should want to see regular corrections. You want it to grow at 10%, pull back at 5%. Grow at 10%, pull back at 5%. That's a more healthy way to approach it, instead of just up and up and up and up. That's never a good thing. When you look at something like cryptocurrencies, you'll see massive swings. You'll see it go, double in one day, and then it drops by half the next day. That's something that, scares the pants off some people. When you look at something much bigger, a much bigger market like the S&P, you want to see those regular corrections. 5 or 10% would be great for the market. But of course, many people don't believe that. They just want it to go up and up and up. That's not a good thing. You need those regular corrections to detoxify the market. All right, then we look at these different corporations. I won't get into all of them. A few big banks and investment companies here have talked about the fact that the stock market is overdue for a correction. What they said is Wall Street banks warn the winter is coming. That's right. So in this particular case, we have HSBC, Citigroup, Morgan Stanley. They see mounting evidence that the global markets are in the last stage of their rallies before a downturn in the business cycle. Something that I've brought up many, many times. I'm the one who gets laughed at. I'm the one who gets ridiculed. But people, they just keep forking their money into these institutions and fueling them. So if you don't like these institutions because they're saying the same thing I am, but you still fund them. Analysts at the Wall Street behemoth cite the signals, including the breakdown of long-standing relationships between stocks, bonds, and commodities, as well as investors ignoring valuation fundamentals and data. It all means the stock and credit markets are at a risk of a painful drop. Is that a quote from the Money GPS? What am I reading here? Everything is disconnected. They're saying it right here. Equity's not correlated with the FX. The FX not correlated with the rates, and they're becoming less sensitive to oil. This is a problem. It's compounding. It's getting worse. And this is what we experience today. That's the banks saying that. That's the institution saying that. They're always the ones who are saying everything is just fine and dandy. That's what they're saying. You know, you got to judge it for yourself. The debt ceiling. Oh, how I love a debt ceiling fiasco. It happens so often, but here we are, 20 trillion in. More debt during every presidency. Every presidency. We will see more debt. I'm sure that we are going to see that unless the entire system is ready to collapse. So, we'll see. Regardless, the debt ceiling every time right now at a $20 trillion mark, what's going to happen with it? Well, once again, we have this situation. Fitch Ratings said the failure to raise the debt limit in the US in a timely manner would prompt to review the country's credit rating, which is at AAA according to Fitch, the highest possible. So this wouldn't be the first time that they've got their credit rating downgraded. We can see that they're unable to make these decisions. The credit rating agencies come out and they say, we're going to downgrade you. So that affects the markets internationally. According to them, it's a big deal. According to me, they're rated at, you know, the worst of the worst. But anyway, what I would say about the debt ceiling is that it ultimately, despite what Obama had said, ultimately will just continue to expand. If they raise it from, let's say, 20 million to 22 million, I assure you the debt will expand to 22 million. And then we will have another debt ceiling fiasco at 22 million. And we will have the same conversation. I will bring to you the same articles and we will have the same discussion. It's the same merry-go-round over and over again. We're on the carousel. We're spinning around. We're on the teacups, getting really dizzy. And nobody seems to notice. And I just wanted to finish off with this here. Google and Walmart have been joining forces in a partnership that includes enabling voice-ordered purchases from the retail giant on Google's virtual assistant, challenging rival Amazon.com's grip on the next wave of e-commerce. So basically, you can use your device that's in your home, provided by Google, and you would speak into it. You would be able to order products, and it would be delivered to your door right away. This is something that Amazon is doing. This is something that Google is doing. We can see that e-commerce is taking over. Brick and mortar seems to be going the way of the dodo bird. And it's something that we need to realize how technology changes and how that affects different companies. I think it's important to note that. I think that as technologies change, we could have something like, you know, different businesses either becoming not necessarily completely eliminated, but let's say there's a financial crisis, let's say, and it may never get to where it was before. Some things will recover after, but other things may not. And that's what we need to understand. And it could be a crisis which really takes it into effect and really pushes it over the edge. So that's a little couple pieces of information. I hope you found that informative. If you did, please give me a thumbs up, like this video, share it, subscribe to the channel. There are now 60,000 subscribers here at the Money GPS. I want to say hello to each and every one of you. I want to extend my gratitude to all those who have supported me, especially recently. I really need it, of course, as you know. So I wanted to say hello, thank you, and if you found this video informative, I know you'll find my books, The Money GPS, and my new release, Global Economic Collapse, even more informative. The first book talks a lot about the fundamentals, we've got the foundation, the 4 asset classes, and how to profit from them, whereas my new book takes on familiar concepts, but I also get into things like tax incentives, earning income, and becoming self-sufficient. So you can check those out at Amazon. The links are in the description below. Take care.